Past few days was quite nerve-wracking for many of the people here because Twitter announced the layoff of 3,700 people that impact 50% of its workforce. About a little less than 1,000 people here in Bay Area got impacted. Just after that, the news came out that Facebook is going to announce layoff this Wednesday. It's going to be quite a few thousand people as well. Previously, the large companies such as Amazon, Apple, Google all said they were going to have a hiring freeze. So how bad it is right now? Many of you may not be here back in 2008 when we experienced Great Recession. So I think it will be interesting to compare where we are today in terms of layoff versus back in 2008, and also how the housing market here today right now versus back in 2008. That can help you to answer a very important question in terms of should I buy a house or it's better to hold off. 2008 was a big recession time. At that time, the really huge amount of people got laid off. For example, just 2009, January alone, there are about 25,000 people got laid off. That doesn't even count the announcement by large company at that time, such as Sun Microsystems. At that time, they announced about 6,000 people laid off, Motorola about 3,000, and Dell another few more thousand. By the way, Sun Microsystems and Motorola no longer exist anymore. So that's how bad it was. And unemployment rate at that time was like over 11%, double digit. Now, if you look at today, I went to look at a website. It's called layoff.fyi. So it tracks all the different companies' announcement of layoff. I put together the data and counted the layoff it announced there for the whole year in 2022. It's over about 24,000. So that's the whole year compared with just 1 month in 2009. Also, if you look at unemployment rate data, it's still pretty low. The unemployment data announced back in October is actually really good. It added about 260,000 jobs, which is 20% higher than most of the analysts' expectation. On top of that, we are really just slightly above the 50-year low unemployment rate ratio. It's at about 3.7%. So that's where we came from. Of course, I think we're likely to see more increase in terms of unemployment ratio. But that's a far cry from what happened back in 2008, the double-digit unemployment ratio. So if you look back 2009, at that time, you can see the headline, it's over 12% unemployment. Silicon Valley housing price is always very expensive. The major forces that drive the housing price is because of the high-tech companies, good job, good salary. Now that with this kind of job market and expected layoff that's coming, how it's going to impact the housing market here. Now the pricing dropped quite a few over the past few months since the interest rate goes quite high. How is that compared with back 2008? Because back in 2008, the mortgage rate is very similar as today. It's in a range of 6 to 7%. One major difference is the inventory level. I pulled out the single-family house inventory back in 2008 versus today. As you notice, 2008, the total single-family house available in Santa Clara County alone is over 7,000 units. Now today, even after the pricing drop and the slowdown of the market, still the total single-family house available in Santa Clara County is in the range of 1,500 to 2,000, which is much, much less than back in 2008. If you look at the townhouse, the trend is very similar. Total available units back in 2008 for townhouse and condo in Santa Clara County is around 2,200 units. If you look at today, that number is barely 500 to 800 units. So it's only about half or less than half of the housing supply back in 2008. In addition to the inventory level, there are a few other major differences of the housing market now versus back in 2008. First, 2008, there are very loose lending rules. So the major trigger of 2008 recession is the subprime loan issues, which means at that time, the lender does not ask you for document. You can just tell lender whatever the amount you earn, they're going to give you the loan. That led to a lot of people cannot afford the payment when the pricing start to drop. Now today is very different. After 2008, the lender tightened the rules, and all the people who are buying houses since 2009 have to go through very rigorous lending examination of their qualification to get a loan. You need to have good down payment, good job, good credit. These are all the things lender check in order to give you the loan. The second difference is the delinquency ratio. Back in 2008, 2009, the delinquency ratio was much higher. Today, this number is very low, especially in California Bay Area. 2010, the delinquency ratio is as high as over 11%, while 2020 Q1, it's only over 2%. This is the chart that shows you the delinquency ratio in different stage of the loan performance. So look at the 30 days delinquency ratio, August 2022 versus a year ago. It's 2.8% versus 4% a year ago. And 30 days to 59 days was slightly higher, 1.2 versus 1.1 about a year ago. So the midterm, like 60 days up to 90 days, even up to 120 days, a super low delinquency ratio. When you look at delinquency ratio over 90 days, serious delinquency over 90 days, again, this year is much lower than last year's. So across the board, you see a drop of delinquency ratio this year compared with a year ago. This is the national data. If you look at the delinquency ratio in San Francisco Bay Area, it's even lower. 30-day delinquency, the data in 2022 August, it's around 1.3%. And the serious delinquency rate, August, it's about 0.5%. So overall, the delinquency ratio is still at a very healthy level. The third difference is homeowners. Majority of the homeowners here in Bay Area has large equity in their house. San Jose metropolitan area actually ranked the top 3 in terms of the equity-rich homeowners. That means over 65% of the homeowners in Santa Clara, San Jose metropolitan area has over 50% of equity in their house. That means for majority of the homeowners here in Santa Clara, San Jose metropolitan area, the housing price has to go down quite a lot for them to go negative, which is quite different from back in 2008-2009 period. Back in 2008-2009, there were quite a lot of short sale and foreclosures because of the bad loans. We don't see that happen today. Another important factor is interest rate was very low a few months ago, beginning of this year, even last year. We had a rate as low as about 2% for 30-year fixed. So many homeowners already took opportunity of those low rates and refinanced their mortgage into those very low rates. That give even more protection to weather the downturn of the housing market. That is one of the reasons why you didn't see the increase of inventory that much due to their low monthly payment. If you bought a house recently, no need to panic as well because it's a pretty long-term decision to own a house. If you look at people who bought in 2007, it was the peak before the previous crash in 2008. The single-family house median price in Santa Clara County 2007 is lower than $1 million. It's around $800,000 to $900,000 at that time. Now, today, even after about 20% drop since the beginning of this year, the median price in Santa Clara County is still way over $1.5 million. The previous peak, 2007, townhouse condo price in Santa Clara County was around $500,000-ish. Today, this number became about $1 million. Back to that $1 million question, should I buy now or should I hold? I hope today's video gave you perspective about where we are compared with worst time back in 2008-2009. I think it's a good time to evaluate everybody's personal situation. If you think you have a very good job security and you're planning to hold house for long term, this could be a good time to buy a house at a reasonable pricing. However, if you are concerned about your job security and you are likely to move to different areas and not planning to hold a house for very long term, that may not be a good time to buy. So let me know what your thoughts are. Leave your comments below, or if you would like to have a one-on-one discussion to analyze further your personal situation, feel free to reach out to us.